Hey, this is Adam Huxama from Projection Hub, and today I have a set of financial projections that a client sent to us just for us to review and provide some feedback on before they sent these off to their lender. And they were in the process of seeking a couple $1 million USDA loan, along with seeking investor funding and maybe some other more traditional loans as well. So a lot going on here. I actually thought these were pretty sophisticated financial model here, and specifically what this company was doing is building a manufacturing series of different what I guess I'd call motorsport type vehicles. So ATVs, four-wheelers, dirt bike type products. So that was a model, and they put a lot together here. The kind of the sales model that they were using is that they were the manufacturer, and then they would sell through dealers. So really, it's the model is kind of like Ford manufacturing cars and then selling through dealers. So I'm just going to kind of walk you through the model that they sent to us and point out some things that I thought were really great about the model, and then maybe really just some things from the lender's perspective, since they were seeking a USDA loan, and kind of what would a lender be looking at and maybe concerned with or not understand in this model. So with that intro, let me kind of get into it. So on this first tab, they had their different models of vehicles that they'd be manufacturing, kind of costs and retail prices, and you can kind of see their gross margin per unit, and very detailed here. They included their shipping costs, their warranty costs, their duty cost, their freight cost, and then also this was a sales expectation, the number of units that each dealer would sell per month. That's where they were including their expectation of that sales per month. And then they'd also sell parts and accessories, and they have a gross margin of 110% there. They've got some assumptions here about their growth rate of dealers that they would have in year 1, year 2, year 3. They've got some seasonality. So since these are outdoor type vehicles, they're showing a decrease, sales decrease due to seasonality during the winter. They built in some annual price increases here, and then they have this 3-month ramp up period. And so you can see this is really effectively a cash flow model. In total, they need $10.2 million, it looks like, to get started. And we'll take a look at. This is actually the use of proceeds tab I'm jumping over to, but you can see they need $8.7 million in total funding. $4 million of that is operating cash or working capital. $1.8 million for purchase of land and plant. Now this, I believe, was what they were looking to get that USDA loan for, was this $1.8 million. And so just kind of jumping back over here, yeah, so they're looking at USDA $2 million. They need 1.8 for the building, and then $200,000 for rehab of the facility. So I think these two kind of make up the $2 million for the USDA loan. And then you can kind of see here, and this is really all just month 1, 2, and 3. So this is a serious operation that would have quite a bit of expenses here. You can see use of cash here in the first couple months of nearly $5 million. So then this is kind of, there's statement of operations. So this is like once they're actually operating and manufacturing the units. And the key here is how many dealerships they're going to have. They're adding 7 dealerships per month, it looks like up here. And remember, we knew like how many vehicles each dealer would be selling based on the assumptions tab back over here. So there's your mix. And, this all looks like very detailed, well thought out. Seems like they're catching a lot of the things that I would expect. They've got, property tax is a pretty substantial number here, but that would be to be expected with a property of that price. They've got their depreciation and interest expense because they're going to have a large loan or several loans. So that makes sense. I would say one thing that I would be somewhat surprised at was, in general, their gross profit margin for a manufacturer. 63% gross profit margin seems pretty high. And so that would be, as a lender, that would be one of the things that I would look at right off the bat. I don't think that is very likely possible. Most manufacturers would have a much lower gross profit margin. So especially with the price points of the vehicles that they're selling, you're just unlikely to have that level of profit margin, gross profit margin. That is one red flag I saw. They have a very detailed payroll summary here. Again, this is all reasonable, and I guess one possible. So if we look at production here, production of 24,000. If we just jump back to this, I do think. That's a payroll D95. It could be that they're, yes, so they are including, I think, let me check one more thing. Yes, okay, that's confirmed. So they're including, in this payroll expense under operating expenses, they are including their production workers here as operating expenses instead of labor expense as part of their cost of goods sold. And so maybe that would kind of resolve my concern over here. If you had your labor expense for the production of the vehicles, manufacturing of the vehicles, up here in cost of goods sold, then this gross profit margin would be lower and probably more in line with what I would expect. So then you'd really be looking at more like, just to get a gut feel of whether this makes sense, your net income percentage, your net profit margin here of just under 20% for year 2. That probably makes a lot more sense. That's probably a reasonable. It's still probably higher than I would expect, but more within the realm of possibility. And so it's really, I think, just a categorization issue of cost of goods sold. Otherwise, this looks well thought out and very reasonable. You've got your balance sheet here. Again, very detailed. Some things that I noticed. You've got an SBA closing fee here and an SBA deposit, which if this is SBA as in Small Business Administration, that just threw me off a little bit because I didn't see, maybe that's this long-term debt number here of $15 million, but previously we were looking at a $2 million USDA loan. So yeah, just a little bit unclear in terms of just the funding that they're looking for. Funding sources, we didn't have any specific detail about where that funding was coming from. So, that just kind of stuck out. I also am not sure of the accounting treatment, but I would be a little bit surprised that there'd be an SBA closing fee and deposit that should be showing up on the balance sheet as an asset, but could be wrong there. Cash collateral here of $2.5 million is kind of an interesting thing too. I don't know if it's like, is it double counting this cash here in the operating account, or is it a separate cash collateral account that maybe they've set up for the loan, and that's possible too. So anyway, it kind of summarizes all down here to profitability. So profitability in year one, and then actually profitability going down in year two. So, this is just a little surprising. I mean, to be at that level of profitability in year one of a manufacturing startup seems surprising. If you watch what Tesla does as an example of a manufacturing startup that has been in business for over a decade now, and this kind of profit margin percentages would still be unheard of for them. So maybe a little optimistic here. We have the breakdown of the use of funds, and then just a calculations tab. So overall, this is a well thought out, I think, and nicely designed, and it seems it seems legitimate. I think a couple of things that are unknowns, and as you're putting in this kind of money or investment into this as a lender, my biggest question is probably going to be all about this column. How do you know you're going to have the dealers are going to sell one per month, 1 unit per month, 1 unit per month of all of these different products? And the fact of the matter is they don't know because they haven't manufactured them yet. But this is what makes manufacturing startup company a vehicle. This is sort of a vehicle startup, just really tough because it's going to take you a long time before you even get to see how are the dealers selling. And if we change this to 0.5, I think this will work. Let's just say change all of those from 1 to 0.5. See if I can come and see some of our summaries. Okay, yeah. So when I change those from 1 sale per dealer per month to 0.5, your net earnings went down substantially in year one, and then you're actually at a net loss in year two. So you can see how much is riding on these assumptions right here about whether this business is going to be able to make a go of it. And this is why I think the Tesla model makes some sense, and what they did very early on was pre-selling and getting deposits. That helped prove to their funders that there was demand. And so if you're a manufacturing startup, if you're able to pre-sell, this is kind of the Kickstarter idea. If you're able to pre-sell on Kickstarter or just pre-sell through your own efforts, that would prove demand and actually have some customer deposits that kind of even further prove that they put their money where their mouth is. They're really going to purchase and help you understand what price point they're willing to pay. All of those things would be really important here, I think, as you're trying to raise money for an endeavor like this. So yeah, and that being said, also if you are raising this kind of level of money, I think, and USDA and SBA was mentioned in here, they have some specific projection kind of expectations in terms of monthly projections for a certain number of years. And so I'm not sure that this is quite meeting that requirement. I think it may be a little bit short. It may need 3 years. It may need monthly for longer. So we do have a template in our template library at Projection Hub for manufacturing startup, and I'll link to that in the description of the video here. But that would meet any USDA or SBA requirements in terms of what your projection file needs to have in it. And so, you could really take a model like this, which has all the assumptions, kind of plug this into our financial model, which has a monthly projections for up to 5 years with the integrated balance sheet, income statement, and cash flow statement all put together with some nice dashboards and graphs and tables and charts and that sort of thing that may be helpful as well. But all in all, I thought this was a really good, well thought out set of projections. Seemed like they'd done their homework and seemed realistic, but everything hinges right here on, will anybody buy, and at what pace? Will they buy it 1 per month at the dealer level, or less, and what a difference that can make. So just wanted to point that out, how small changes, a seemingly small change, can make a huge difference in a financial model. And that's all I have for you today. Thanks.